Welcome back to the Business Loan Basics video. This is video number 3, and we will talk about what it takes to get a business loan, what banks or lenders look for when approving your loan. My name is Robin. I'm a capital advisor, and I work with businesses to help them access and secure business loans for their businesses. As a reminder, this is the third video in a series of videos. The first one talked about different types of loans, the Loans 101. Video number 2 talks about good loans and bad loans, and when they're good for your business and when they may not be good for your business. We'll talk about the process and the effort to get a loan, and then the last video we'll talk about some common fears and misconceptions about loans. Just as a reminder, as in the past, these videos are prepared for businesses located in Portland, Oregon. Anybody can watch them, and I'm sure it has good information for any business in the United States. However, we will be referencing examples and organizations here in the Portland area in this video. And big shout out and thanks again to Prosper Portland, who is supporting us in providing these and all the other capital advising videos that we have on this channel. So with that, let's start talking about some of the requirements. So the first requirement is sufficient profits. Profits are what repay a loan. So, a lender is going to look for sufficient profits. And banks, because they're going to be regulated and they're going to be a little bit more conservative, they're going to want to look at historical profits. They want to see that you're generating profits the last 2 years and have that confidence that you can continue making those profits so that you can repay the loan. And a rule of thumb, they want to see profits about 120% of the annual loan payments. So if you have a monthly loan that is $100 a month, the annual loan payments is $1,200 a year. And so they want to see profits of at least, I'm terrible at live math, $1,444 in profits for the year. And that gives them a little bit more of a wiggle room in case things don't go right. But that's what they're looking for. Every bank will be different. Some will go lower, some will go higher, but just back of the envelope, look at 120% of annual loan payments. As I said, most bank lenders will want to look at historical profits, which creates a challenge for young businesses, right? If you're a startup, you don't have any history. And as a young business, chances are you don't have any profits. So that's one challenge why startups and young businesses can't access capital. And that's where community lenders, as I talked about in video 1, come into play. They are able to take on a little bit more risk, and some of the community lenders are willing to look at forecasted profits. So what you predict in the future as profits, and if you can meet that 120% threshold in your forecast, they will be willing to extend a loan to you. Now that doesn't mean you just make up a number and show 120% ratio. They're going to scrutinize you. They're going to ask questions. They will pick apart your forecast to make sure that they have confidence and make sure you have confidence that you can attain those numbers. But at least they're willing to consider forecasted profits, which is going to be very beneficial to young or startup businesses. And so what if you don't have sufficient profits? Forecast more increased profits. And again, I don't mean make up the numbers, but what can you do to your business to generate more revenue or lower your costs? There may be costs that you can delay. There may be strategies that you can pursue to generate more revenue. You're the best person to know that, so factor that into your forecasts. You can always reduce the loan size, right? Maybe a $100,000 loan is way too expensive, but maybe you can fulfill the obligations for a $50,000 loan. Now that means obviously you can't do as much for $50,000, but that is your factor that into your growth plan, factor that into your capital plan. Just being able to, grow your business with less money, and then maybe a few years later you can get additional capital if all goes according to plan. And then, as I said earlier, seek a community lender. They're going to be typically less stringent on their requirements, more flexible, and they may be willing to work with you if you don't have sufficient profits. The next thing, and it's kind of tied into the last one, is they want to see at least 1 to 2 years or even more years in business. And the reason why is that, track records are very important to lenders. It demonstrates that you're a financially viable business. If you survived for 2 years, you're on the right track. If you're a 6-month-old business, no one has any, you might have gotten there by luck. And no one knows if you're going to be able to continue that. So, and it also demonstrates that you've gone through 2 years, and that, you've gone through some seasonality, some changes in your business, and that you have, experienced management in your business, both you, the owner, as well as other people or staff, if that's applicable in your business. So track history is important. And what if you do if you're too young? Well, wait it out. And just plan your big capital acquisition for years 2 and 3. Don't expect to get that $60,000 loan, for example, or whatever much, after year 1. Build out your growth plan so that maybe it's after 30 months, and that's when you build out the plans. Again, maybe you can't grow as fast. But just accept a tree sapling is not going to grow into a redwood, in 6 months. It's going to take time. So just accept that is part of life and reality in this universe anyhow. Seek a community lender. Again, some of them are willing to make loans to startups and very young organizations. Under certain circumstances. So they can be more flexible that way. Another option, and I talked, this is a very viable option for many young businesses, is consider a personal loan or a credit card that you have in your name. This is not a business loan. A business loan is by definition a loan that is in the name of your business, and your business is responsible for making the loan payments. Whereas a personal loan, this is you as an individual going to a lender, going to a bank, and saying, I, would like to have, this capital. Some banks are, if you've done banking with them, have your checking account with them, they want to keep you as happy customers, and so long as you manage your bank account fine, they may be willing to extend a small loan just to grow and maintain that relationship. So definitely, talk to your personal banker and see if they're willing to do something. Some people who are fortunate to own a home, they may have equity in the home, and they can take a home equity line of credit or home equity loan and borrow against the equity in the home. Then whether it's a home equity loan or a personal loan, you take that money that you personally get, and then you invest that money back into your business with the hopes that the business can then turn around, start generating more profits that repay you as investor, and then you can take that money and repay a lender. So that is a very viable, and many businesses, business owners do that. If you're getting just a standalone loan or a unsecured loan or a credit card, you're not probably going to be able to access that much money. But if you're able to secure a home equity line of credit and you have some equity in your home, you may have access to larger sums of money. Another thing that lenders will want to see is a 680 or more credit score, and 680 is kind of a vague number. Every lender is different, but generally, upper 600s or higher, 700, 800. If you're in that range, your credit score is in that range, you got a pretty good shot at everything else being equal. You got a pretty good shot of getting a loan. If you're below 680 or below 650, so low 600s or even lower, it's going to be almost impossible for you to get a loan from a bank. And the reason why is they use credit score, even though this is your personal credit score, and you're getting a loan for your business, there's a high correlation around how, a business owner manages their personal finances, is very similar to how they would manage their business finances. So if you able to manage your personal finances effectively and have high credit score, there's a strong indication that you're going to do the same with your business. And the credit score is just a very easy, low-cost way for a lender to look at a number and kind of quickly assess your credit worthiness. So that's why it's a key factor. If your credit, and one more thing about credit score, they will typically want to look at the credit score of each owner of the business that has 20% more of the business. So if you have 5 business partners and each business partner has 20% of the business, they will want to look at all the credit score for each of the 5 business owners, and they'll look at the person with the lowest credit score. Again, every bank would be a little bit different, but that's probably a kind of a safe assumption to make. So what to do if you don't have your score is too low? Seek credit repair or counseling. Do things to build up. If your credit score is low because of delinquencies and late loan payments, that's one path. There's one path to go down to repair that credit. If your credit score is low just because you have too much outstanding debt, that's another path to go for. If your credit score is too low because someone hacked your social security number and started taking loans out in your name, that's another course of action that you need to pursue to repair your credit. If your credit score is too low because you're maybe you're an immigrant and don't have a thick credit file, or you've never had that much credit, there are other ways to build up that credit score. Maybe it's getting a small loan just even if you don't need it, just get a small loan, and every month you make a monthly payment, just to build up that credit score. So these are all different strategies. There's others out there. I'm not an expert on that, but there are organizations out there that have that expertise and can help you in that. And this is particularly important. If you don't need a loan today, but maybe you need one in 3 or 4 years, check out your credit score now. And if it's low, start repairing it now, because it could take time for you to repair your credit score. And ideally, you get it higher enough so that when you need that capital, 2, 3, whatever years down the road, your credit score is then in a good place. The other thing you can do, again, is seek out a community lender. A lot of community lenders, they don't look at the credit score, they look at the history. And there's a difference, because credit score is a number. History kind of explains why your credit score is low. And these community lenders, if your credit score is low because you have a medical debt, but everything else is looking fine, they may be willing to extend a loan to you. If you had a bankruptcy 6 years ago and it's still on your record, a bank lender is probably not going to loan to you. But if you can show to a community lender that, yeah, this bankruptcy happened 6 years ago, it sucked, but I've moved past it. I've always been making payments, since then. They can look at your credit history, confirm that you've been, on time with your loan payments on your other credits, and willing to extend that loan to you. So, community lenders could be another resource for you to go to. Related, is lenders don't want to see any adverse records. We talked in the last slide about recent bankruptcies. There could be liens and tax liens from the IRS or the state of Oregon for any back due taxes. Those are killers. If you have a tax lien, what tax lien basically means is that if you don't fulfill your obligations to the IRS or to state of Oregon. Because they are a government entity, they can come in at any time, swoop in, and basically pull out whatever. Tell the bank that you hold your money. We have this tax lien. We're the IRS. We're the government. We want you to take out $5,000 from your bank account to repay this tax obligation. They have the power to do that. No one else does. And so you have a tax lien on yourself or your business. It's a risk to a lender because the IRS can come in and take whatever money that you may have allocated to pay that lender, but just use it to pay off back debt. So if you have a tax lien, that's first, avoid getting into a situation that puts you in outstanding debt to the taxing authorities. So what if you do if adverse records exist? If it's a bankruptcy, you can wait it out. Typically you need to wait 7 years. So if you're in year 6, you got 1 more year, not the end of the world. But if you just had a bankruptcy 6 months ago, you're gonna have to wait a while, and that's just the unfortunate reality, here in the United States. If you have a tax lien, you may be able to work with a lender, particularly a community lender, to refinance that tax lien, and basically say, let me borrow money. I owe $5,000 to the IRS. Let me borrow the money so that I can pay off the IRS. The IRS can then, take the tax lien off my business or off me. It'll still say in your record, and that will represent risk. But the fact that you don't have an active lien makes your situation less risky. So you may be able to refinance that tax lien and just end up owing someone else that money. It's going to probably be difficult to get it. Like I said, trying to get a loan in the first place for the lien is difficult, but that's why I have community lenders. They're willing to do that. As a former community lender, I've refinanced some tax liens because everything else about the business is strong. They just had this, burden that's, in their background. And we were able to go in, refinance the tax lien, and give them some capital to grow their business. This is an absolute must if you want a loan, and that is financial statements and tax returns. If a lender is going to extend a loan to your business, they want to know how your financial health is, and you need your financial statements, accurate, reliable financial statements, to provide to any lender, particularly bank lenders. And it's just a way to assess the financial health of your business. Similarly with tax returns, they want to see timely tax returns. Tax returns, they represent a limited attestation that your financial statements are true. You're filing your tax return under the perjury of law, that they're accurate. And so, it's not numbers that are made up. Sure, people do it, and that they get caught. They can be, there could be criminal proceedings, behind them. So, your business, typical small businesses, getting an audit is just too expensive. So, tax returns are a good proxy for accurate financial statements. And this is where I've seen the most number of businesses not get a loan because they don't have the tax returns. Now, I would argue, and I agree, that a lot of businesses, they operate their business based upon what they see in the bank statements. If you have $10,000 in the bank, that's how much you can spend. At the end of the next month, if it's $12,000, yeah, maybe you made a little bit more money, and that can work. That can work for a while, but it won't work for a lender. You really need financial statements, and I've met so many business owners who either don't want to make that investment, they hire a friend, or they ask a friend or a relative to do that at no cost, and their financial statements are a total mess, or they just don't do it. You will not get a affordable business loan without financial statements. I can't say that any stronger. It is an absolute must. Now, if you don't get your financial statements, yes, you can get a lender, and those are typically those 48-hour lenders, the hard money lenders. They have a very different model for lending, and they're willing to extend loans to folks, to businesses that don't have their financial statements. And I know a lot of businesses have gone to them for that very purpose, but they are paying an arm and a leg for that capital. You know, by having financial statements, you have a strong idea of how your business is going. And so, yes, you can get away for it for a while, but if you are serious about growing your business and want to be able to operate your business with confidence, you really need the financial statements. So I can't stress that enough. Make that investment, hire someone. They're not necessarily that expensive, or learn how to do it yourself. There are tons of classes and programs offered through Prosper Portland. So I would encourage you to, you know, go to their website and, you know, look up whatever option makes most sense to you, whether it's hire a bookkeeper, whether it's taking a training course on a bookkeeping system, maybe it's a little bit of both. There are many different options that are out there. Many of them are affordable. There's many resources out there. Many of it is free or low cost. It is just essential. So if you're going to take one thing away from this video, is get your financial statements in order. And if you're not available, you know, again, personal loans, you don't need financial statements for personal loans or credit cards, but then again, you're not going to get that much capital. And, you know, work with a community lender. You know, they will still want to see a financial statement. So you're not going to be able to get away with that completely. But they may be willing to help you develop those financial statements, give you some guidance, or provide some assistance to create those financial statements from scratch. So talk to them. Collateral. As I mentioned in the first video, collateral is a piece of asset, equipment, car, real estate, that can serve that you pledge to a lender that serves as a backup form of repayment. You know, in the event that you default on a loan, they would then acquire, you know, ownership of that asset because you pledged it to them, and then they would sell it and apply the proceeds to your outstanding balance. They will typically want the value of the liquidation value of your collateral to be 120% of the outstanding loan principal. And again, the 120%, that will vary from lender to lender, but you know, it gives them some wiggle room. You know, if they can't sell it at top price, and in fact, oftentimes they sell these assets at auction, so they're not going to get a top price. They're going to get a fast sale and you know, allow them to, you know, quickly apply it to the outstanding balance. So they need a little room if they're not able to get the total value. It's also important that, you know, a lot of businesses that manufacture, they can say, oh, I have inventory that I can pledge. But you know, inventory, yes, they'll take it, but they may discount it. You know, they say if you have $100,000 worth of inventory, we're going to assume that, you know, it's worth only $50,000 or even $25,000. And that is because if you default on the loan because you are not able to generate sufficient profits because you can't sell enough of your products, and you're an expert in your industry, how do you expect the bank to liquidate your assets in an industry that they're not familiar with, and you know, they can't get, you know, anywhere near top dollar. So inventory, yes, you can pledge it, but you know, banks are going to discount that significantly when considering it as a loan collateral. And one nice thing about equipment or real estate loans is that the asset that you're acquiring, the property, the equipment, particularly if it's a big equipment, if it's a, you know, $3,000 tool, it's not going to be worth much. But if you're talking about, you know, a $10,000 refrigeration, $20,000 refrigeration unit, that's a sizable asset, and not only space-wise, but you know, value-wise. The item that you purchase can also be used as collateral. So that's nice, and that can be handy. So what to do if there's insufficient collateral? Reduce the loan value. Less loan requires less collateral. Get additional collateral pledges. And, what I mean by that is other assets. I should have rewritten that. Maybe you can cobble together, other assets that you can use to make up for the collateral. Another option is loan guarantees. And we haven't really talked about loan guarantees, but they're typically offered by the government. And typically the biggest loan guarantee program is the SBA. And they will guarantee a loan for a lender. These come in not 100%, but like 80% of the value of the loan. So if you take out $100,000 loan, they'll go to a lender and say, okay, we want this industry, we want this business to thrive for economic development purposes. We're willing to guarantee 80% of the loan. So in that case, $80,000. And that significantly reduces the risk for the lender. So much so that then they may be more willing to extend a loan to you. And this comes in very handy if you have insufficient collateral. And I've done loans where the owner just didn't have any collaterals to pledge. So we were able to get a loan guarantee. It reduces the risk for the lender. If that's the situation, consider, a lender that uses, or takes advantage of loan guarantees. And not every bank or lender will do that. Some do it exclusively for every deal. Others just do it on a one-off. They don't even do it at all. The couple caveats is that there's a lot of paperwork that's involved with putting together a loan guarantee. So if you're talking about a $10,000 loan, it's not worth it for them to pursue the hassles to get a loan guarantee. $100,000 loan, it starts making sense. So loan guarantees are typically more available for bigger loans. And loan guarantees, they absolve the lender of the risk, but they don't absolve you, the borrower, from the risk. So if you default and the government comes in and gives them 80% of the loan, doesn't mean that you're off the hook. You actually still have an obligation to the federal government, to the loan guarantor, to make those payments. So it's not like you can just walk away from it. You still have that obligation. And the only way you get out of that obligation is if you declare bankruptcy, which some businesses, some individuals do, but obviously there are some ramifications, negative ramifications around that. But they're an option, and these loan guarantees exist for the myriad of situations when there's insufficient collateral. And then, as I've said time and time again, seek a community lender. Oftentimes, they're able to make a loan with no collateral or significantly fewer collateral given the circumstances and your particular needs. Next thing that you want is a plan. And what I mean by this is the worst thing you can say to a prospective lender is, I'll take whatever I can get. And the reason why that's really dangerous statement is it says that you don't have a plan. You don't have a plan for how you're going to use the money, and you don't have a plan, more importantly, to the lender of how you're going to repay the loan. So you definitely need a plan, and that is really a forecast. I'm going to borrow $50,000. This is how much, this is the return on that investment, and this is how I'm going to repay that loan. You need a plan. It doesn't have to be a super fancy spreadsheet, but you want to have a plan and you want to be able to communicate that to your lenders. So how are you going to use the funds and how are you going to repay the funds? What to do if you don't have a plan? Everybody wants to see a plan. So you're not going to be able to get away from this one. But you can work with advisors to develop one. Some of the work I do and some of the work that some other advisors, that work in conjunction with Prosper Portland, we're available to provide guidance and support in helping you develop a plan. And then you can also, again, consider personal loans or credit cards. They don't require a plan, or at least the lender doesn't. It's still good for you to have a plan, but the lender doesn't require a plan. And as it's largely based on, your credit score. So those are some options that you can pursue if it's difficult for you to put together a plan. The last thing I'll talk about in terms of requirement is a personal guarantee. And, a personal guarantee, every lender is going to require that, even a community lender. The two primary reasons is one, well, really the same reason is the lender wants you to have skin in the game. They want you to make sure that you're making decisions on behalf of the business that are aligned with your ability to repay the loan. If you didn't have a personal guarantee, you can make a decision about your business, that takes the business and in a direction that can't repay the loan, and if you didn't have a personal guarantee, you're off the hook. So they don't want you to do that. They want you to make decisions that are in the best interest of the business and in the best interest of repaying the loan. And it's we'll show in a few slides in the next video a backup form of repayment. So you need one. And I know everybody is averse to giving a personal guarantee, but that's just just like we need air to breathe air, oxygen to live. You need a personal guarantee for any business loan, and even the hard money lenders. Sometimes they also come with a personal guarantee. The last thing I want to talk about is the typical process and the timeline for getting a loan. And the process consists of a plan, developing a plan. It takes anywhere from 1 month to 6 months. I've known businesses that plan this for years. There's no right or wrong answer. It's just whatever you need to plan. And this is really how much money are you going to need? What type of loan? Is it line of credit? Is it a term loan? How are you going to use the funds? What is the desired return? What is your in terms of return on investments? Are you eligible? Maybe you're not eligible to get a loan for a variety of reasons, and that's something that you have to incorporate into your planning process, and some type of forecasting, again, just to make sure that you have the means to repay the loan. Once you have a plan and you decide to move forward, then it's shopping around. And oftentimes people don't realize that you're a customer of a bank, of a lender. You can shop around. Every lender is going to have different terms, different underwriting criteria or approval criteria. And just like you would shop around for a car, you can shop around for a lender. And find a lender that offers, sometimes you might be able to get better, support, better interest rates, whatever it is. Every lender, like I said, is different, and you may be able to have friendlier terms with one lender over another. So it will take time to shop and find out which ones are most, best fit for your business. When you start the process of applying, then that involves filling out an application, submitting a bunch of reports, doing forecasts, and starting what they call the underwriting process, in which all your information is then submitted to either, sometimes it's done by computer, sometimes it's done by an analyst, an underwriter, who will review the information and assess the risk of your loan given the lender's criteria. And again, every lender is different. So what may look really risky for one lender may be a piece of cake for another lender. So you have to apply, a bunch of paperwork up front, and usually followed by some Q&A afterwards. And that will take, if you're approved, that will take you to closing. Expect 2 to 4 months from the moment you submit your paperwork. And it takes time for them to do this review. You're not going to get the money overnight. It's going to take some time, and particularly if you have some challenging situation, it's going to take a little bit more time. So give yourself ample time to apply for the loan. Once you're approved, and you then start into closing, and that's where you negotiate the terms. Some loans have some terms that are negotiable, some don't. It just depends on the lender and your needs. So you can negotiate your terms. You review the documents and sign the documents. and then you receive the funds, and then you deploy the funds. So that's the closing process. And then the final process is not really part of the loan application process, but as part of the loan process is what the lenders call servicing. And that is for the remainder of the loan. That's your monthly payments and other obligations you have to make to fulfill, to satisfy the conditions of the loan. So that's the typical process. I think if you're just beginning to think about a loan, give yourself at least 6 months. Don't get rushed. The more you get rushed, the less options you have for your loan. So that's it for this one. I know it's a long one, but there's a lot of information here, and that's it for now. And we'll see you for the next and last video. Thank you.